Now, with rising interest rates and the fear that the housing market is going to drop even further, you're probably wondering, is SmartCentre a safe REIT to invest right now? This stock has dropped 20% since its peak over the last year, but it has a dividend yield of over 7.5%, which makes it really, really interesting. Now, SmartCentre's biggest strength and biggest weakness comes down to its anchor client, which is Walmart, where it collects over 25% of its income from Walmart. But Walmart has been recession-proof because it sells almost everything you could think of. Now, SmartCentre owns 188 strategic locations in Canada, and 98% of its locations are occupied, and it collects over 99% of its rental income, which is amazing. Now, SmartCentres did take a hit where Bed Bath & Beyond did go bankrupt, but it was only 2 locations in Canada. And those 2 locations are already leased out again. Now, with the US banking crisis happening in February, and with housing prices in Canada, some dropping more than 15% compared to last year, could this affect the real estate prices in SmartCentres? And most importantly, could it affect your passive income that you're collecting from SmartCentres? Now, if you're worried about the safety of those monthly distributions, there's 3 metrics that I'm going to look at. Their occupancy rate, which is like what's the percentage of properties are occupied by tenants. Number 2 is this payout ratio, which is like saying how much of its profits is it paying to investors month after month, and is it sustainable and safe? And third, what is the value of their real estate compared to the debt that they have? Obviously, you don't want them to be completely leveraged. I look for less than 50%. If their real estate is worth $8 billion, I want to know that their debt is $4 billion or less so that they can weather bad storms. Now, when I look at their occupancy rate, it looks like it's very, very good. Over 99% of their properties are rented out, which is an improvement since the pandemic levels. Now, when I look at their payout ratio, which is the adjusted funds from its operations, which is just financial jargon to say how much of its profits is it paying to you and I? Well, the thing about REITs, by law, they have to pay a minimum of 90% of its profits, being rental cash flow and the sale of the properties, back to you and I after all expenses. So obviously, you don't want any REIT to be paying 98% of its profits back to you and I. Otherwise, it's unsustainable and they have no cash reserves if anything happens. When I look at SmartCentres, I could see that its payout ratio is improving over the last 3 months from 96% down to 93%, which is amazing. The next metric I look for is this debt to asset ratio, which is financial jargon to say how much is this real estate worth compared to how much debt it has. And I like to look for a metric of less than 50%. When I look at SmartCentres, it is at 43%, which is amazing. Now, if SmartCentre can survive the worst events in the past 20 years, which is the financial crisis and the 2020 COVID pandemic, where the economy was shut down and is able to still collect rent and pay out its monthly passive income to all the investors, where none of its payments were ever cut, well, I feel that it can weather a lot of bad storms for the foreseeable future, including a rising interest rate environment. It's nice to see that 83% of its mortgage payments are under fixed rate mortgages, which means that, well, they're not as sensitive to rising interest rates because they're already locked into a fixed rate for the foreseeable future. Now, when I look at its financials, its net operating income, which is simply its rental cash flow minus all expenses, and not considering mortgage payments, is increasing over time, which means that they are able to increase rent over time, which is amazing. That means when you buy commercial property and you're able to increase rent, the market value of those properties go up over time. Now, you're probably wondering, okay, with rising interest rates, wouldn't it be sketchy to invest in real estate right now because the mortgage payments are going to be a lot higher and its dividend yield is already so high, maybe it's a dividend trap. So let's talk about the best case scenario and the worst case scenario, and I'll tell you what I've done. In the best case scenario, if you feel that interest rates can slow down and start dropping, and you are bullish about the real estate market prices over the next upcoming years, because real estate values will go up in large urban areas where SmartCentres is investing in, and you believe that SmartCentre can continue to improve its payout ratio and continue to pay monthly payments to you every single month for the foreseeable future, well, right now, you have more than 7.5% dividend yield and a chance to get 15 to 20% of capital appreciation. Now, let's talk about the worst case scenario. If you feel that interest rates could rise in the future and housing prices could drop accordingly, and you're worried about the monthly distributions from SmartCentre, well, there could be a chance that SmartCentre could cut its monthly payments in order to ride that recession type environment, which means that this dividend yield could drop from 7.5% to 5%. And if you're relying on these monthly payments, maybe it could be too risky for you. Now, in my humble opinion, I've been investing in SmartCentre over the past month. I feel that the risk versus reward ratio, well, the risk is a lot lower than the reward. And I love it when the CEO has also purchased its own stock, a whole $499,000 worth of its own stock in its last month. But of course, none of this is financial advice, so do your own due diligence. This is only for entertainment purposes only. And by the way, if you are looking for more passive income ideas, check out this video out here. If you're interested in another high yield dividend stock like Enbridge and wondering, is that yield safe? Check out this video down here. See you in the next video. Bye.